Continue on with where we left off the other day. And so this is where I started losing you guys last time. So I'll just go over that quickly. So there are many ways we can classify a stock as more or less risky. So one way to do that is to look at blue chip stocks versus value stocks versus growth stocks. And so the idea is that blue chip stocks are the least risky, growth stocks are the most risky. Okay, so that's one way of classifying stocks in the risk scale. Another way is to look at the size of the company itself. And the way you think about the size of a company is to look at the market capitalization of a company, which can be thought of as large, medium, large cap, mid cap, and small cap. And large capitalization is anything above $5 billion, mid cap 1 to 5, and less than 1 is small cap. And and then there's another category called micro cap, which is about $500 million or less. So it's safe to say that large caps are considered to be least risky, and the small caps or micro caps are the most risky. So again, so that's another way of classifying risk. So in terms of their label, they're blue chip or not, and we talked about what blue chips are, and name recognition, brand that we know needs no introduction. So those are, so blue chips and large caps, those are the safest, and then the others are riskier. So there is this term that we've almost come to accept in our folklore called Ponzi scheme, and you've heard of it, and it never fails that every semester, and I'm sure, and I know one of you will be asking me this, so I will go ahead and say this. Every time we talk about, it has never failed in the last few years, or as far back as I can remember, that when we talk about Ponzi schemes and then we talk about Social Security, one of you always say, oh, isn't Social Security a Ponzi scheme? Which, of course, the answer is no, it's not. But I will, and we can discuss that. But so this term has become a sort of a, like Google. Let's Google something. So it's Ponzi scheme has become a catch-all phrase to describe any fraudulent activity. But Charles Ponzi was actually this guy. If we can move this up, can we? Why is this? Okay. Why is this? Oh, there you go. So this is this gentleman. Of course, Bernie Madoff is right next to him, which and you've heard of Bernie Madoff recently. He ran the scheme, Ponzi scheme, basically. It's a pyramid scheme. Ponzi scheme was first thought of in modern times by this guy called Charles Ponzi, and at the turn of last century. And he duped a lot of people in a lot of money, and using a scheme that never really existed. And so the idea is you take the new investors' money to pay off old investors. And as long as you can keep up this scheme and enough new investors come in all the time, you can continue this process of using new money to pay off old investors so that there is an appearance of legitimacy for a while. But sooner or later, this scheme falls apart because you don't have enough people to funneling in to keep this process going. Because you're not really producing anything. You're simply taking money, robbing Peter to pay Paul kind of thing. So you're simply taking new investors who are coming in line, paying money to be a part of the scheme. You are taking their money and paying off investors whose monies are due now because they've been in the scheme for a while. And as long as enough new people come in, you continue to do that successfully. But sooner or later, this thing unravels. And that's the problem. But so we thought we could watch a short history on Charles Ponzi. Can you start that from there? So it's a YouTube video that I thought was quite instructive, actually. I think you'll. So let's watch this. Should we dim the lights? No? Bright, dim, mid. There you go. Mid. Let's try dim. Wow. Some mood music.
which apparently he was taking, purporting to be
getting
jump? 10, 15%
returns
on their money, when in fact he had lost all of it, and was just continuing in a pyramid fashion to get more investors' money and pretending to pay off the old people with new people's money. And now $50 billion in assets are wiped out.
He's talking about Bernie Madoff.
It's claimed he tricked his clients with a so-called Ponzi scheme. Investors are offered abnormally high short-term returns, but their payouts come from money put in by new investors rather than any real profits generated. Such operations often collapse or are exposed before huge fraud takes place. Not this time, it seems.
Quite entrepreneurial. This is where you start paying attention, the International Postal Coupon. So everybody wanted in on this action. $420,000 is a lot of money in 1920.
Quickly engendered panic amongst investors who gathered at the offices of their alleged swindler. Bernard Madoff was a Wall Street legend and pulled in big clients with big checkbooks.
You always manage to get caught. Okay. He never gave up. He kept trying. Do you have anything more on? Okay, it's almost over. All right, so the idea was there's international reply coupons where he bought them cheap in Italy, and sold them in the U.S. Basically, his idea was to sell them in the U.S. more expensively and make profits. He did a little bit of that, but most of the time, once the frenzy spread and everybody was trying to get in, so he stopped doing all of that, and he kept simply funneling money from one to the other, and trying to and continue this scheme for a while. Similarly, Bernard Madoff did the same thing, and the difference is Madoff continued for about 30 years doing this, and he was a consummate insider. This guy on the right. And in Wall Street, he was well known. He was in all the important committees, and so nobody suspected that he was doing this. And it was really, when you think about all the clients that Madoff had, all dying to invest in his investment schemes, it's sort of reminiscent of what Ponzi was doing. The same kind of thing 100 years later, and you'll see this happening all the time. That there are people who come and promise you all these things. Great returns on investment, and they could be your friends, your neighbors, people you trust normally, and that's what makes it kind of hard to detect a lot of times. And we have, as a culture, we know we are reluctant to ask hard questions because we don't want to offend somebody. We're too polite, and that's why I keep saying, don't be afraid to ask the hard questions, even if it means upsetting somebody or whatever it is. So. And you can see that you can pull these up and read them. NFL players tangled in Ponzi scheme. So it just happens all over the place. There's some examples of this. So and Ponzi scheme, interestingly, continues to happen, continues to take place even today, in spite of all that is written about it, everything we know about it, all of the scams that have been uncovered. It continues to thrive, which is amazing. Because it takes advantage of our inherent greed, I think, for money and the desire to get something quickly and fast. And I think that's what causes these things to flourish. Okay, so stock analysts. Analysts are typically professionals who are employed by brokerage houses. Big brokerage houses on Wall Street employ these research people. They are considered researchers. And they provide analysis on various sectors, on stocks, and so on. But the same brokerage houses also provide investment banking services that we talked about in the last class that helps take companies public, private companies public. So Facebook and other Google, all these companies that go public go through these same investment brokerage houses that employ these stock analysts. And what these companies try to do is to keep the research wing separate from the investment banking arm, which is the one that's making the money in the firm, and the analysts are the ones providing research. But in reality, what happens is that there is, or what has been happening is that there's a cozy relationship between the analysts and the firms that they cover, because these same firms happen to be clients of the investment banking side of the firm. So that creates a huge conflict of interest, and so that's been uncovered now. Over the last decade, it's been shown that these analysts were providing fairly biased coverages of these firms that they were tasked to cover, and so and this has led to a lot of investigations, and finally, a lot of light was shed. A lot of the big brokerage houses like Merrill Lynch and so on paid millions of dollars in fines to the SEC for these kind of activities, which were shady activities. But overall, there's some value to analysis. I mean, you have to take it sometimes with a grain of salt, but here's how they work. Stock analysts usually categorize stocks in terms of these 5 classifications: strong buy, hold, sell, and strong sell. 1 being strong buy, 5 being strong sell. And their job is to really do research on the companies or the sectors that they are supposed to be covering, like oil and gas, retail, utilities. These different sectors have analysts that are experts on those. And typically, they will be the ones that will get on the quarterly analyst calls with the company's top officials, CFOs, CEOs, asking them questions about the company's future prospects and things. And so, and in fact, we will post some typical conference calls that analysts participate in for you to listen to if you're interested, and see what kind of stuff is said in these and what kind of questions are being asked by analysts. It's kind of fun listening if you're interested in this stuff. Maria, remind me to do that.
We have links to publicly available.
With NOV, or is it?
I think with Microsoft or whatever.
Okay, so okay, yeah. So it's already, we have that link, and she'll tell you where to go. So here was the problem, that first people started noticing that very few analysts said bad things about companies. Less than 2% of stocks were rated as sell or strong sell. So that created immediate problems. That what's going on? Why should there be so few sell signals? And that's when the whole investigation started, and all these connections were uncovered. But and so here was the thing, that the money that these brokerage firms made came primarily from these investment banking relationships with the companies. The same companies, and a lot of times, that their brokerage, their research side were covering. And the problem was that if they wrote negative things about those companies, these companies would then threaten to pull out business from the investment side of the firm. Millions of dollars would be at stake, and therefore, guess what happened? And so a lot of these analysts would be fired, or they'd be told to tamp down what they wrote about these people, and so on and so forth. So that was a problem. And a lot of investigations later, a lot of light has been shining on this industry. So it's one can say that a lot of the problems that were there probably have been taken care of. It's still not a perfect system, but now you can see, when you look at more recent analyst ratings, you can see that the negative ratings have gone up significantly since those days, 22%, which is a significant jump. And so things are in the right direction, probably. But again, as in all kinds of investment strategies, you shouldn't take one piece of information and make decisions. It's always about taking information from multiple sources and then deciding what it is you want to do. And so using analysts as one source of information is a good idea, and as long as you mix it up with other things as well that we'll talk about. So, and there is a lot of, so there's a link that we're not going to waste class time over. You feel free you're free to go in and check this out. There's a half-an-hour show that's on YouTube called Confessions of a Broker, of an Insider, Wall Street Insider. These are interesting pieces to listen to and see. It's a YouTube video. So here's we'll look at Facebook, since we're all familiar with that, and we'll see how analyst ratings look for Facebook. So let's pull it up. So this is under Market Watch, and so when you no, hold on. Let me start at the top. Yeah. So 53.8387. So markets are open right now. They're going to close at 4 p.m. So in about 10 minutes. Eastern Standard Time. So you can see the price is changing. So that's the price right now, 53.91. That's what Facebook is trading for at this very moment. But you can see, and so you can see it's going down or going up. The red arrow, so it's 53.88. So it's changing pretty much every second. Now you can see that analyst recommendations. You can see that it's on average it is a buy. Okay, so average recommendation still is a buy. On not a strong buy, but a buy. And you can see the number of ratings, 45 analysts. So that's another thing. When a stock is particularly popular, they have more analysts covering it. So looking at the number of analysts covering a stock is an indication of how popular a stock is likely to be. And obviously Facebook is a lot in the news. It's a popular social media company, so it's being covered by a lot of analysts. 45 analysts is quite a bit. And you can see the average target price is 62.19. It's currently at 53.86. So so it's close enough to its ceiling of what it's expected to be. And you can see that you can see analyst recommendations broken down here. Currently, 35 are saying buy. 1 month ago, or 34. So it's been fairly stable over the last. So ideally, you would like to see the trend going upwards over time. And you can see that it is. So this is sort of, you can recast this in the strong buy, hold, sell, strong sell, as the buy is really a strong buy. Overweight is what we call buy. Hold is do nothing. And then underweight is sell, and sell is a strong sell. So you can remap what we just talked about in this scheme, because sometimes they express these things slightly differently. But you can see overall this is a very positive thing. So analysts are really saying, buy this stock. So and that hasn't changed in the last couple of months. Okay, so let's go to the next one. So here's upgrade, downgrade. That's another way of looking at this whole same company. You can see which brokerage firms are saying what, upgrade, downgrade. So when you want more stock, more analysts to upgrade than downgrade, obviously, if you're interested in buying that stock. So you can see all these brokerage, all these analyst firms here. These are all underwriting firms, investment banking firms. And so their analysts have they've upgraded, downgraded. So very few downgrades, mostly upgrades. The greens are. So overall, there's a positive feeling about this. If I were to just try to summarize the feeling about the stock currently, it is positive. Okay? Few negative undertones, underpinnings, but mostly positive. And then here's a NASDAQ earnings forecast on this stock, and you can see, so you can see all the earnings for it. So EPS is earnings per share. So this is in 62 cents. 0.62 is 62 cents, 88 cents, $1.23. So those are kind of consensus forecast on earnings. Okay, so this is what they're predicting the earnings would be, and that's essentially what the actual earnings are compared against. So every quarter, earnings come out. All these companies have to report their earnings. And if the earnings are at or above their estimated earnings, then it's a good news. And if it's below, then it's bad news. That's how they're judged. So that sort of it gives you an idea of what analysts do, and you want things to be on the positive side for all of these. And so there's this important regulation that came about a decade ago called Regulation Fair Disclosure, or Regulation Reg FD. FD stands for Fair Disclosure. And the governing principle underpinnings of this regulation was that Wall Street had this habit of leaking privileged information to its best clients. So if you were a $1 million investor, multi-million dollar investor, and you are a big client of a particular investment banker in a brokerage house in Wall Street, you would get privileged information on a particular stock or stocks that the market didn't yet have. And you could conceivably invest money in those recommendations, and obviously you would be at an advantage relative to, say, the Joe Blow in the street who would not have any idea. They would get that information maybe 2 days later, or a day later when this report would be officially released in the public domain. But the informed guys, the big guys, insiders would have like a 24-hour advantage, which is an eternity in the investment world, right? Even a few minutes is an eternity. If you have a 5-minute advantage, that's an eternity to make a ton of money. Or even if you had a 1-minute advantage these days, or even 30-second advantage, today's world, that's an eternity now, because things have just become faster and faster, and with these algorithmic tradings and trades occurring in nanoseconds now, things are just, it's all computer algorithms doing it, so you don't really need the human intervention. So that's really cut down on the time, and all you need is like 2 seconds of advantage, and you can make money because you've got computer algorithms who are just doing these trades for you. So anyway, so the point was that, so this was happening, and so regulation fair disclosure was passed as a way to level the playing field. So the SEC said, wait a minute, this is not fair. You got to be fair to everybody in the street. So all information has to be released at the same time. You cannot selectively give good information to some of your clients and not to others. If you have to do it, you have to do it to everybody or to none at all, right? So what happened was companies decided that, hey, we're not going to release information at all. So it was your way, you either do it our way or the highway. Well, it was sort of the highway. Companies decided that they're not going to release as much information anymore because, they didn't want to offend their big clients. The problem with that logic has been that it has lowered the quality of information coming out for everybody, and that's not a good thing for efficient markets. Because if markets have to be efficient informationally, it has to have all the information quickly in these stock prices. If the quality of information that's coming out is compromised, then that affects the markets for everybody, and that's been a problem. That's become a problem that's been reported. So that's one of the side bad things on the side for this regulation. That was unintended. That was not what the regulation intended to do, but it has had this problem, unintended bad thing that has come about. Okay, let's see what we have question-wise. So let's do a quick. Oh, okay. Let's put it on the screen. Can we do a quick quiz? Write up a question here, A, B, C, D, E. I have no idea at this point, but I'll think of something. What is SEC? Very good. Securities and Exchange Commission. It is the regulating body of the stock markets. It's called it's the policeman. It's Wall Street policeman, if you will. It is the regulator that controls, makes sure that everybody behaves. Securities and Exchange Commission, SEC. What makes people who work on Wall Street from using insider trading to their own personal advantage? What makes people, maybe you want to say what stops people? Nothing really. You can, as long as you're not caught. It's great. I mean, look, here's the thing. A lot of people are probably doing it. Not probably, they are doing it. The point is that, and the SEC knows it, but these kind of cases, insider trading cases, are notoriously difficult to prosecute. Very expensive and very difficult to get a judgment. So if you don't get too greedy, let's say, hypothetical, all right, your brother-in-law is somewhat, a semi-big cheese in company X. He finds out that something good is a good merger is going to go down, and that once that's announced, price is going to go through the roof. Well, he tells you. He says, hey, listen, I got a hot tip for you. Company X, the company I work for, this is going to happen in the next 2 months. Load up on this stock. Okay, now there are two ways you can go about this. One is you don't go hog wild, and you say, okay, it was a good tip. I'll put a few $1,000s in it, and let's say you do, and good things happen, and you make a few $1,000 profit. You probably don't know, but you've been flagged. But they look at it, they say, okay, made some money, let it go. You got off the hook without you even knowing about it. But let's say you go stir crazy. You mortgage your home, you put all the money you had, and you put like $5 million into it. Okay. Now you have crossed some, and so $5 million, the stock price, let's say, doubles, you've made $5 million profit. Guess what? You are clearly on their radar now. Now an investigation has started because you've been greedy, but you've been super bad greedy. As long as you were slightly greedy, it was fine. They knew about it, they let it go because it was not worth their while to come after you. Now, having made so much money, now you definitely made it worth their while to come after you. And that's when people get tripped up, is that as long as you don't get overly greedy and you get these tips and you make a little money for yourself, they will let it go, because it's not worthwhile economically for them to chase down every one of these things. But if you get too greedy, you're likely to be flagged, and that means you'll have to go through the process now, and that's not fun. Whether they get a judgment or not, that's a whole different thing. But they have lawyers, they have resources which you may or may not have. Of course, with the money you just made, you may have to spend a lot of that in trying to defend yourself in that case. So that can be a problem. Is it now too early to start a retirement fund? This person, anonymous, although I do know who you are because we can look you up, but anonymous for the purpose of this class, is ahead of his or her time. Because yes, you can. It's not too early, and we will talk about this when we get to Module 4. You can start right now. Yes, but this is not, we're not talking retirement yet, but yes, the answer is yes. You are not too early. In other words, you can start. Can we believe so-called analysis? Yes and no. Sure you can. I mean, don't throw the baby out with the bathwater. Yes, no system is perfect. I mean, there's just, everything is questionable. So take everything, look at look at it from different angles. Look at the analysis, definitely value to it. Just because there's some bad actors and bad apples doesn't mean everything is bad, so yes. Okay, who's in charge of the SEC? There's a commissioner of the SEC that's appointed. They are under the federal government, but they operate separately. But they report to Congress and so on and so forth. So it's not a private organization, it's a government body. Why not is Social Security not a Ponzi scheme? Okay, I kind of invited this question, didn't I, by talking about it. Okay. Or why was the comparison made? Well, the point is that a Ponzi scheme means that a person deliberately set out to defraud somebody. There is, if you look at the history of Social Security, and we will talk about it when we get to Section 4, and that's why I would respectfully ask you to hold on to this thought till we get to that point, and then we can talk about it again. I'm sure that we'll discuss this again. So, and the answer is no, and I will be happy to talk about it at the right time, and we will, because you've got to look at the history of how Social Security came about. What was the guiding principle? It started in 1935 by FDR. Roosevelt signed it in the wake of the Depression. There's a whole bunch of stuff we need to talk about, but this is not the right time because we're not talking retirement yet. So hold on to that thought, and we will certainly revisit it. Okay, is it recommended for us to start practicing investing? Yes, with a small capital. Yes, absolutely. Yes, no, you can have a little bit of play money, whether it's $200, $300, whatever, Christmas money you got from your grandparents, whatever, you can start. Absolutely, and it's very easy to set up online brokerage accounts. In fact, the reason we play these investment games in the class, and we will start soon, is for you to feel comfortable and see that it's really not as, there's no big myth to investing. It's really very simple, and as long as you don't go crazy and try to make a ton of money and you're reasonable in your expectations, it's a pretty good thing to do, and you can make decent returns out of it. I've heard of retirement accounts that rely on how the stock market and how well it is doing. Should the retirement money go elsewhere? I'm not quite sure I understand that. Money is invested in all these sector funds. We'll talk about these ETFs and all that. And so depending on what you believe, you're in charge of putting the money in. You decide what kind of risk you want to take and accordingly decide where the money goes. When was the SEC developed? You mean when was the SEC started? When did it start? I'll have to look it up. It's been about a number of years. I would say in the 53, 50. Can you look it up quickly? When was the SEC? When did the SEC start? When was it? Oh, okay. Can we do it in another computer that's not being used? Yeah. Okay. All right. So, okay. All right. We'll come back to this. Let's go on. Otherwise, we won't be able to. So, okay. I'll answer the rest of them as we go along. So when we trade, there are these two terms that you need to be comfortable with: the bid price, the ask price, and the difference between the 1934. So 1935 was when the Social Security Act was passed. 1934 is when the SEC started. So it's been a while. It's been there for a bit, right? Almost 100 years. Well, 90 years, 80 years. So ask price is the price at which we buy shares. We buy shares at the ask price, and we sell shares at the bid price. And the difference between the ask price and the bid price is called the spread. Okay, the difference is the spread. Ask is the higher price, bid is the lower price. So we buy at a higher price, and we sell at a lower price. And the difference is it should be ask minus bid. So the bid asks, even though it's called the bid ask spread, really the spread is ask price minus bid price. Okay? And this is the cost that we as investors incur. So notice that I said we buy at the higher price, we sell at the lower price, which is different from buying low, selling high, right? So we buy high, sell low. And so in the process, we incur a cost. It's a cost to trade. And the reason we incur the cost is because we are taking a position as and when we want to. We buy when we want to, we sell when we want to as investors. There are people on the other side, market professionals, who are required to take the other side of those trades, even if they don't want to. Their fiduciary responsibility is to take that other side of the trade. They are the ones who earn that spread for taking that position against us, for being forced to take that position against us. When we want to trade, they have to be on the other side of the trade. These are the specialists and market makers that we'll talk about. And they're the ones who are earning our spread. The cost that we are paying, they are the ones that, so they're the ones that are earning the money. So this spread, this difference between the buy price and the sell price, is a measure of uncertainty in the market, in that stock. So when that spread becomes very narrow, in fact, at today's prices, it can be as narrow as 1 penny. When the spread is at 1 penny, then it means that there's minimum amount of uncertainty in the stock. And when the uncertainty in the stock increases, the spread widens, okay, to reflect that. So decimalization, since about 2001, stock prices in the US have traded in decimals. So it's like $50.40, $50.41, 42 cents, 43 cents, so on. That's decimal pricing. But it turns out that for over 200 years before that, stocks were traded in eighths of a dollar, 1/8 of a dollar. Then from 97 to 2001, it changed to a 16th of a dollar, which is roughly 6 cents. And then from 2001, it changed to decimals, which is where the minimum increment prices are a penny. It can go down a penny, go up a penny every time. What does this change mean for investors? Pretty much nothing. It's a convenience and to be consistent with the rest of the world. Prices are easier to understand, but and one of the unintended, well, probably not that unintended, but once the spreads became, you could increase the prices over a narrower band, like decimals in pennies, rather than eighths of a dollar or 16ths of a dollar. Spreads have gone down. Spreads have decreased. Study after study has shown that spreads have decreased, which means that these professionals, these market professionals, are making less money off of trades now than they used to before. They are very, very unhappy. They're very unhappy. So there's been a large movement in Wall Street to roll back decimalization, to let some stocks trade in wider spreads, like to go back to the nickel spread, 5 cent change for some types of stocks, because the Wall Street dealers have said, we're not making enough money to do this kind of business and take all these risks when you have decimal pricing, because spreads are too narrow. We're not making enough money to make it worth our while to be in this market. And therefore, to appease them, it looks like for some kinds of stocks that have low volume, they're going to roll back decimalization, and we're going to have trading in increments of like a nickel, 5 cents. Okay. So, all right. So we're going to talk about tickers. Stock tickers are important because tickers actually are the way a stock is recognized in the market. So Facebook is FB, right? IBM is IBM. Microsoft is MSFT. So every company that's publicly traded and trades in one of these exchanges has a symbol, a group of letters that denote that company. So that's how you identify that company, right? And it turns out that they're not just meaningless combination of letters. There's a lot of information you can glean, you can obtain from looking at the letters themselves. They tell you a story. They have a story to tell. So a ticker that's up to 3 characters long, they can be a ticker of a company can be 1 letter, 2 letters, 3 letters, 4 letters, 5 letters. Okay? So if a ticker, there are a couple of exceptions, and I'll talk about this soon, but for the most part, if a stock ticker has anywhere from 1, 2, or 3 letters describing it, then chances are very good that its primary home, listing home, is the New York Stock Exchange. Okay? New York Stock Exchange. If the ticker is 4 or 5 characters, or even more than that, then it's a good possibility, in fact, fairly sure, that its primary home is the NASDAQ, or an electronic exchange. So NYSE is the brick and mortar, actual location, physical location place in 11 Broad Street in New York, and NASDAQ is the electronic exchange that is really doesn't have a formal home per se. It's just a bunch of computers that are linked together, and it's electronic exchange that we have. And that's where stocks that have 4 letters, 5 letters or more are listed typically. Now, Facebook is a good example of a stock that has 2 letters. You would think that they're listed in the NYSE, but no, it's listed in NASDAQ. That's a recent exception. But for the most part, this rule holds that now, so you may ask, what does it matter? Why is it important that we know where a stock is listed? What does it do for us? Well, it turns out it does a lot. Okay, so here's the thing. NYSE was established over 200 years ago. So think of it in terms of analogy as an old country club, right? Very, very highbrow, very difficult to get in. People are kind of lining up. They want to get in on it. It's very difficult. You have a process. You have to show that you've accomplished something. You've gone somewhere. You've done some good things. Then you are eligible to be considered for membership. And then think of a recent entry in the club business. They are desperate for business, so they will let almost anybody in, right? I mean, you have to show a bank account, and you're good to go. You're in. Well, this is not quite, but that's a close analogy describing the way to list or the difficulty that it takes to get into NYSE versus NASDAQ, relatively speaking. And one of the things to keep in mind is NASDAQ is the home of all the tech companies, technology, social media. These companies are too risky to even warrant, being considered, to even come, to be considered by NYSE board, listing board. They're not even going to entertain them because these companies don't really have a track record. They're very risky. They don't have. So historically, all of these tech companies, the Microsofts and Apple's, AAPL is Apple's ticker, they've all listed in NASDAQ. And NASDAQ has a sort of a, if you will, all of these are all the tech companies list together, and they're all pretty much in NASDAQ, right, over time. So in between you had Amex, American Exchange, is sort of the NYSE's poor cousin. So what happened in the old days was, before NASDAQ, we're talking 1920s, 1910, 1890s, when NYSE was this, this had inside the building, they had their exchange and things are going on. A lot of the relatively new stocks in those days could not get into the exchange even then. And what would happen is the brokers would trade these stocks outside on the sidewalk. And it was called a curbside market. Literally curbside market outside, where brokers would stand outside in the sun and the weather and buy and sell these stocks that you couldn't get in listed inside the building in NYSE. And so that's how the Amex started. American Stock Exchange started as a curbside market. And literally it was curbside. It was trading physically outside on the street, outside the stock exchange. And that's how NASDAQ came about, Amex came about. And of course, NASDAQ I told you about, founded in 1971. It's the newest kid on the block, very aggressive. It's the home of almost all of the tech companies. Not almost, I think all of the tech. I can't think of an exception right now. All the tech companies, social media companies pretty much list in NASDAQ. So what does the research tell us? Research finds that, and this is a ton of studies, a lot of studies. I myself have contributed to this literature. People show, and without any doubt, if you synthesize all the findings, this is the conclusion. NYSE stocks show smaller spreads than comparable NASDAQ stocks. Not only that, stocks that switch from NASDAQ to NYSE display lower price variability, which is a measure of risk, and smaller spreads. What have I told you about smaller spreads? Smaller spreads means less risk. So as an investor, you want spreads to be narrower. You want spreads to be narrower. That's a good thing for us investors. So research shows unquestionably, unambiguously, that NYSE does better than NASDAQ. When you look at apples to apples, similar kinds of stocks in both exchanges, all the metrics that you can think of unquestionably point to the fact that NYSE is better, whatever way you define better to be, than NASDAQ stocks, unquestionably. So a reasonable conclusion seems to be that NYSE is the place to be. If you can get in there. If you can't, wait in line till you get in and then switch. Go to NASDAQ for temporary home. The moment you do well, become established, and you're invited to join NYSE, jump. Go there. But here's the but. This is a research study that showed that between 1996 and 1986 and 98, over a 13, 14-year history, almost 2,700 firms were eligible to switch to the NYSE from NASDAQ. That their track record was good enough that they could be eligible to switch from NASDAQ to NYSE. And yet, only 460 chose to do so over that time period, which is a 1-to-6 ratio. 1 out of every 6 companies moved over. 5 out of 6 refused, didn't do it. So the big question was why? Okay, that was a research question. What was going on? It's very puzzling because the data seems to suggest unquestionably that that other place is the place to be, and yet the actual data on the ground was showing that companies were not doing so. What was going on? What gives? And to make the story further puzzling, more puzzling, was that Sears had switched from NYSE to NASDAQ, which was unthinkable. I mean, you never. First of all, this is like travesty. This is you couldn't consider it. Like, I mean, you are shunning NYSE to go to NASDAQ. That was unthinkable, and Sears did that. So there's been a lot of explanations trying to explain it. People say, oh, this is it's sort of a group effect. Everybody, companies like Microsoft and all that, they don't need name recognition. They can be home, it can be anywhere, it doesn't matter. But for other companies, similarly, they want to be where their compadres are, where the similar companies are. Okay, I'm starting to lose you guys. And Sears thought they would remake their image by moving to the hipper place, the younger, hipper crowd. That's NASDAQ. That's sort of, let's end it here.